Hi, and welcome to this lecture. So what we're going to do is we're going to talk about the accounting cycle so that we can see how we report our information into periods. In order to do this, we need to see how we journalize post and how we close our books at the end of each period so that we can start our accounting cycle over with zeros in our revenues, expenses, and drawings or dividends. So this will be the accounting cycle specifically to show us how we put our information into accounting periods. First, let's revisit the accounting that we focused on so far. That is financial accounting. That's financial accounting as opposed to managerial accounting. So in financial accounting, it is used for external users, people outside the company. We follow certain rules so that external users can rely on our reports. During this, we use the accounting cycle, which is used to gather the information and report it on a periodic basis. Most companies do this process monthly, quarterly, and yearly. So in order to accumulate it on a periodic basis, we have to do something called close the books, or the closing entries. And this is what is seen in steps 9 and 10 here, where we close the revenues, expenses, and withdrawing or dividends accounts so that we can start the cycle back over again. The next few slides are going to give you a visual of this accounting process and show you what it means to close the books using a visual. So here I am opening up my journal. Now you know a journal is just what happens in our day-to-day lives that we journalize. It is the same thing in accounting, and I'm going to show you how. So this is an example of my personal journal if I were to keep one. May 28th, today I woke up, took the dogs out, then I made coffee and cooked breakfast and fed the dogs and kid. Actually, it's kids. So this is just an example of what happened in my day-to-day life on May the 28th. Let's look and see what a journal looks like in an accounting system. Here's an example of a journal entry, or actually 3 journal entries in accounting. So what we're saying here is that today we affected cash and revenue. Then we affected salary expense and salary payable, and then this is actually some closing entries. So what we're doing here is just writing down what happened to our company's financial position. We use debits and credits to do this, which is just the way of increasing and decreasing certain accounts. So this is called a journal entry, and you can remember that because it's just like a journal, what happened in the day-to-day life. Now, right now, it's just an entry. It hasn't gone into the records. It hasn't even affected the accounts. We're going to show you how we actually affect the accounts next. All right, so just to show you step 1, transactions are analyzed and recorded in a journal. We call this journalizing. Here we have May the 15th, cash increased and service revenue increased because we provided tax return services to a client. Now again, this is just the journal entry. On the next slide, we'll show you how we're going to affect the account. Step 2 is where we take it from the journal and we post it to the general ledger, which is just the account. So here we have cash. It was debited for $6.99. So we're going to debit cash for $6.99. And you can see that this is just the cash account. We started with a balance. We added $6.99 to it and we got to a new balance. Then we need to do the same thing for sales revenue. We're going to post that to sales revenue. So we find our sales revenue account and we credit it for $6.99, which adds to that account. So this is called posting, and I'll show you why we call it posting. Okay, so it might technically not be why we call it posting, but this is how you can remember that it's posted. Here I've written my debit amount on a post-it note. If you notice, this is a post-it note that I've written on. And on the next slide, you're going to see me copying or posting that to our account. So this is going to help you to remember that I copied that amount and I'm now going to place it into the account. We can think of our accounts as buckets because it is where we keep up with all the amounts that went into cash and came out of cash so that we can see our cash balance. We'll have a bucket for every single account. Now, remember, you can call it a bucket if you're silly like me, or you can call it an account, which is proper, or general ledger, or accounting ledger, or just ledger. All of those are referring to our accounts or your buckets. So here I am posting that amount to the cash account. So what I'm going to be doing here is dumping or copying that $699 into that bucket, placing it into that bucket. And I wrote it on Post-it notes so that you can remember that that process is called posting. So we journalize and then we post it by putting it into its bucket. I have to do the same thing with the other entry of that journal. So I debited cash and I credited service revenue. So this is me posting the credit side into service revenue. So I'll be increasing service revenue by dumping this amount into the bucket. After I make all of my monthly journal entries, and then after I have posted them all into the buckets, I need to make sure that I am in balance. What that means is I will look at the new balances for all of my accounts, and then I will write them down. If they have a normal debit balance, then I'll put them on the debit column. If they have a credit balance, I'll put them on the credit column. Then I'll add up all the debits, add up all the credits, and make sure that they are in balance. Since every journal entry had equal amounts of debits and credits, as long as my math is correct, my trial balance will always be in balance. But let's say that I double posted something, forgot to post one of my accounts, did some math wrong, then this would be out of balance and I would need to look back and see where my mistake was. Before we can make financial statements, we look at that trial balance and ask ourselves, has anything happened that we haven't accounted for yet? This is where we would make adjusting entries like depreciation, revenue that we earned during the period that was previously unearned, or perhaps providing services for a customer on account. If those entries didn't happen during the month, but the transaction happened, we make it at the end of the month and we call it an adjusting journal entry. This is called step 4, and it's where we accumulate our adjustment information and we analyze it, and then we'll make our adjusting journal entries. Some accountants use a spreadsheet to see how it will affect the financial statements. Here we can see the unadjusted trial balances, that is the amounts of the accounts before we adjusted them. Then we can see the proposed adjusting journal entries, and in that way we can see how they may impact our trial balance. And then we can even forecast what our income statement and balance sheet will look like with those new updated items. Then we prepare the financial statements. Once that is complete, we need to reset our books so that we can keep up with the next month or year of information. We do this through the closing processes. This is what it really looks like to make the closing entries. We zero out the revenue and expense accounts and drawing if we had one, and we move it all to capital. Capital will hold all of the accumulated revenues minus expenses, which is also known as net income, right? Revenues minus expenses is net income, for all the prior periods. The next slide will give you a visual of this closing process. Here I am having just a little bit too much fun with my buckets, but as you can see, I am emptying revenues and expenses into capital so that I can start the period over with the zero balance to keep up with revenues and expenses for the next period. So the revenues and expenses don't go away, they end up in capital so that these buckets are empty and can start to keep up with the next period's expenses. Now the true way that we do this is through journal entries, closing journal entries, and posting those to the accounts, and it looks like this. Anytime we journalize and post, we always prepare a trial balance to make sure that we're in balance. This trial balance is called a post-closing trial balance, meaning after we closed our books. So you'll notice it's much shorter, and that is because it doesn't have revenues and expenses in it, because the revenues and expenses right now at this point in time have a zero balance, so we just don't include them. All the revenues and expenses have been dumped into capital and are included in that capital number right there.